Is the Australian property market in a bubble in 2025? Hi, my name's Owen Rask. In this video, I'm going to tell you the truth about the Australian housing market and why it may or may not be in a bubble. I have outlined 6 really telling data points and considerations that you should think about before you go and buy a property or invest in more of it for yourself. Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Welcome to this episode of the Australian Finance Podcast, a short episode on housing in Australia, and in particular, is the property market in a bubble? Let's start with number 1, probably the hottest topic of all, which is immigration. This statistic that I'm about to throw out will come back throughout this short podcast, and I want you to keep this number kind of in the back of your head. In the year to 30 June 2024, Australia welcomed over 440,000 new people. This came at a time when there was only 1% vacancy rates for residential properties. So if you're renting, only 1 in every 100 were available to rent. Yet we added 440,000 new people needing homes. Now, I don't want this to sound negative, because immigration is actually one of the most wonderful things for Australia, because migrants bring a lot of labor and they actually stimulate the economy and are actually a fantastic investment for our country. So it's actually a wonderful thing. The problem is there's a lot of people and there ain't many houses getting built, which I'll come back to in just a moment. Effectively, what happened is this surge in people looking for homes has resulted in rents going up. So even though the prices of property over a very long period of time are going up, undoubtedly, you got to remember the income that people who own the property receive is also going up. So it can subsidize or at least provide relief on some of the costs of a loan or a mortgage on a property. So more demand from people entering Australia, plus people already in Australia. Think of young families or think of people graduating from uni that are looking to buy a home or even just rent one, is creating a significant amount of demand for housing, whether you're a homeowner, an investor, or indeed a renter. So the first fact to consider is immigration. It's strong and it doesn't look like it's going anywhere, because our country actually needs it to continue to thrive and grow over the long term. According to the government, the average or median rent in Australia was $627 per week. But what's interesting is over the 3 years to the middle of 2024, that had risen 9% per annum. So a significant increase in the amount of rent that people were paying 3 years ago and landlords were receiving. Keep in mind, this comes at a time of rising interest rates, which I'll now cover. Number 2 is rising interest rates and interest rates generally. With a bigger loan on a property, you pay more in interest and your repayments go up as you have to make the principal repayments. You have to pay down the loan. What's really interesting is if you cast your mind back just 4 years ago, the official interest rate was less than 1%. So in effect, people were paying a lot lower amounts on property out of COVID and were able to therefore borrow more because the bank said, don't worry, you don't need to repay as much. Fast forward a couple of years and all of a sudden, people are paying over 6% in interest rates on their home loan. Remember, banks typically assess you for between 4 and 6 of your annual salary is what you can borrow. So you earn $100,000 for round figures, you may be able to get a loan of $500,000. But as interest rates go up, obviously the amount that they're willing to lend you goes down. So it may be at the lower end of that range. This obviously affects people's ability to buy houses. However, we saw during that period, house prices actually went up. How does that happen? A lot of the times this happens because about 1/3 of Australia's property is owned by investors. That means about 1/3 are renting and the others are owned, under a mortgage or just as a mortgage-free homeowner. And effectively what happens in property is the renters help to cover the costs that the landlords face when interest rates go up. If your mortgage goes up and you're renting your house out to someone, you're more than likely to pass on the cost or share it with them. But then if you're the renter in that property, obviously housing is extremely important to you. So what will happen is you're more likely to prioritize paying your rent and having a house that you want to live in, or a home or an apartment or whatever you want to call it, so that you can afford to stay there and keep that place. Effectively, that's what we saw out of COVID. Really low interest rates going to really high interest rates would normally put a lot of pressure on property. And we saw a lot of people in the media say how housing prices were going to crash. But as you're finding out in this video and this podcast, really, it's only one thing of many that are really important to consider with Australian property. So in effect, what this means is even though interest rates went up, property prices went up because a lot of the costs that were being paid could be passed on to the renters who prioritized keeping their living standards rather than foregoing that for them. When we then consider if this bubble is going to burst, obviously we need to consider if the whole system has too much debt. It's over-leveraged. The bubble is about to burst because people won't pay back their loans. Only 1 in 5 houses are facing mortgage stress, which is higher than previous years, but it's still pretty low when you consider that 1 in 5. From the bank data, we can see that only 1% of loans are what we call non-performing, so where they're at serious risk of default. So it's unlikely that we're going to experience a GFC-like US property market collapse where people are just throwing their keys at each other and saying, here, you take it, because we're not at that point. In fact, we're quite a way away from it just based on the data alone. On to point number 3, which you'll see in the media a lot. Point number 3 is all about comparing the price of a house to the income that that household generates. In recent years, we've seen a stretching of the ratio between the price of the house and the income. And this obviously is a direct, impact on how much of a loan and how much serviceability the particular household can bear. We've seen that ratio of price to income grow to 8 times, which is significant for many people. Think about that for a moment. Your household income is $100,000 and the property price is $800,000. That's an 8-to-1 ratio. So we've seen that stretch as people are willing to put more money on the line and divert more of their income to a loan in order to secure a property. As I mentioned, property prices have been on the rise and it's outpaced the rate that wages are going up. So in effect, not only are the house prices going up, but the wages that people are earning aren't keeping pace with the amount. So the stretch in that is becoming more pronounced. Keep in mind, however, that since 1990, we've seen many households have 2 incomes. We've seen wages across the board increase dramatically. So there has been, over decades, this kind of structural thing where more than 1 wage on average in a household, plus people earning more, naturally would lead to more people spending on properties. So it is kind of expected that you would see that ratio stretch, maybe not to the point that it has, but it is kind of common sense that that would go up. So if anyone that you listen to or watch is saying, well, look at this ratio, how out of control it is, it kind of misses the broader picture, which is what's actually going on in households where oftentimes the husband and the wife or the couple are working together to pay off the mortgage. One of the things that happens when prices of properties go up, and indeed we've seen that over the last 5 years, where the average household has seen a $230,000 increase to the value of their assets. So the property has gone up $230,000. One of the things that happens is people feel richer. Even though it's the same property, even though they haven't sold it yet, they feel richer. That gives them more confidence to go out and spend money and to do things like renovations or spend at Bunnings. And in effect, it stimulates more of the economy. So over time, rising house prices are actually really good for people's enthusiasm and willingness to stimulate the economy every time they open their wallet. Number 4 is housing supply, the number of houses getting built. The government has come out in recent years and put an outrageous statement out that they want to build 1.2 million more houses. Now, that sounds great, but who's going to build them? Where? And which council's going to approve it? Those are the constraints that any one of us are thinking about whenever a big policy announcement like that is put in place. Effectively, what this policy put forth is that we would need to build 240,000 houses a year. In the first year of the policy, we didn't even reach 170,000. So, in effect, we're falling well short. We need to build around 57,000 houses every 3 months. Now, obviously, government initiatives take time to put in place, but we're building less than half of that at the time of recording. And that's because so many things need to fall into line for this to happen. And at the same time as we're putting more pressure on the system to build more houses, we're naturally seeing the prices of things go up. Building costs are on the way up. Labor prices are on the way up, predominantly thanks to unions. And we're seeing the cost of putting a new house in place rise over the long term. So naturally, when the cost of doing something goes up, the prices are also going to go up. Once again, people earning more and things becoming more expensive is a negative for people that want to buy a house, particularly if it's a new one. But importantly, it does actually stimulate the economy. And this is why the construction industry is so vital to Australia's interests. It is important that we have a thriving construction industry, but at the same time, we need to be mindful that the costs are not getting out of control. Number 5, investors are coming back. As we sit here in 2025, falling interest rates, the optimism that's renewed as a result of that and many other things post-COVID has now meant that investors have a bit more certainty. There was a few years there where investors who would buy residential properties were faced with almost unlimited land taxes, were facing a lot of potential legal changes in the form of what could be claimed as a tax deduction and so forth. But obviously, we don't just need the government to invest in property. We also need individuals, we need investors. In 2024, we saw a 17% increase in investor loans, and investors now make up around 37% of all new housing loans. So investors are still stimulating the property market, and they're doing it in a big way. This is really important for all of us that might want to invest in property to make money, but then also facilitate a rental place for other people to live in. And so over the long term, provided that these dynamics remain in place and the government supports investors, we should be able to see more housing stock come to market and eventually help the construction industry catch up with the demand that it is facing. Number 6 is the lending standards. Obviously, we've all seen movies like The Big Short, where there are some people that may have multiple houses and not really realize all of the loans could create almost like a house of cards that fall down at one point or another. Interestingly, in Australia, we maintain a 3% serviceability buffer. And basically what that means is when you get a loan from a bank, the bank is required to stress test your borrowing power against a 3% increase in interest rates. What would happen to your loan and to your ability to repay if interest rates went up 3%? That can obviously keep some investors out of the market or even homeowners, because you may not be able to say, well, I can get an interest rate for 5%. Why are you saying it has to be 8%? That's to protect you and the system overall. This is a really important step for our housing stability and for our banking system. And so far, what we can see is that housing affordability and the lending standards seem to be working really well. In March 2024, only 5% of loans had a debt-to-income level above 6, and only 6% of new loans had a loan-to-value ratio of 90%, meaning that only 6% had a loan with a 10% deposit. What that basically means is more deposit equals safer for the system. So it's actually showing, the data is showing that vast majority of people have good savings buffers, have good value buffers in place for the properties that they're buying. One final thing that I'll add on here, and it's probably in support of that we're not in a bubble, is that as a result of COVID, the savings rate amongst Australians went through the roof. People couldn't spend on new cars or overseas trips. So what did they do? They invested and they saved money. That's been really, really good. So that's provided more money in offset accounts, more money in savings accounts and term deposits and so on. Now, over the last couple of years, households have had to scrimp and save. Undoubtedly, it has become tougher in the last 2 or 3 years, especially with inflation. But overall, the savings buffers that people put in place those years ago have now gotten them through to where we are today. So the savings buffers for people with home loans, for investors, and so forth have really come through. And that has kind of underpinned the serviceability and the ability of people to repay their mortgage on time. Ultimately, where do we sit? We've got huge immigration. We haven't got enough houses, but interest rates are coming down and wages are going up over time. Plus, we have households with multiple incomes, and we've got a really good, strict regulatory system that keeps big risks out of the way. So ultimately, on balance, it looks like house prices could continue up over time. Now, there have been some taxes and things that have changed, like land taxes and state-by-state rules that haven't really been in the favor of people owning property. But overall, it looks like the trend is to consistent increases in property prices, particularly as interest rates fall. There are risks that you should know, and you should track the data points that I've mentioned in this podcast. But overall, it looks like it's a good long-term outlook for property prices. And if people can save up the deposit, that's great news for you to get on the property market in 2025. Be sure to speak to a mortgage broker or expert before you go and jump into a property. And if you are looking to buy a property in 2025, the best thing to do is to get in touch with your mortgage broker, ideally 3 or 6 months before you actually want to buy. It gives them more time and you more time to put strategies in place to help you save faster, but also help you get into the house that you want. So this is a short podcast on is the property market in a bubble in 2025. I'm pretty optimistic. I'd love to know what you think. Let us know by writing in comments or leaving feedback, whether you're on Apple, YouTube, or Spotify. We'd love to hear from you. Thanks for listening to this episode of the Australian Finance Podcast. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.